All right, so Netflix stock is down more than 12% over the past few days, coming off of its most recent earnings call. We're going to dive into the stock and the business and see what the outlook is like and whether the company might be mispriced at the current prices. All right, so as we know, Netflix is by far the largest streaming service in the world by revenue and profit. They have over 325 million subscribers globally. That number continues to increase. And they've done really well over the last few years. 15.8% revenue CAGR over the last 3 years, 45.2% EPS CAGR over the same period. Free cash flow grew nicely as well last year. And their long term trends look fantastic. Solid revenue growth over the last 10 years, expanding gross margins, expanding operating margins, expanding net margins, solid earnings performance, and rising free cash flow. Their balance sheet has gotten stronger as well, and this net debt position is now actually quite a bit lower compared to the fiscal year 2025 number because of the $2.8 billion payout that they just got from Paramount. They've also been buying back their own shares. So overall, this is a fantastic performance in the last 3 years. You really can't do much better than this. Now looking forward, growth is expected to continue for both revenue and earnings. But here's the fine print that has a lot of investors on edge. Even though growth is expected to be strong in 2026, management expects this to slow down in 2027 and onwards to a growth rate of around 11.7%. Now that's a deceleration from the current top line growth. Now, on the other hand, margins are expected to continue expanding, which is fantastic. And when you look at both of these things together, decelerating revenue and expanding margins, you now start to get a much better sense of what's happening within the business. Netflix is now focusing on monetization rather than just getting more people. They're now a hallmark brand with a massive reach, and so the strategy is starting to shift from massive expansion to profit maximization. And this is where things get interesting because even though margins are expected to expand, net income growth is also expected to decelerate. That sounds backwards, but it's possible, and it's simply because Netflix is much bigger now. They've already pulled in sizable profit numbers, and for a company of that size, it just becomes harder to grow those numbers at the same pace. So in short, Netflix is moving from a hyper growth phase into a slightly more mature phase of growth, and that implies lower revenue and EPS growth rates. Now, unfortunately, this is something the market is not very excited about. But moving on, we can see that Q1 2026 performance was really good. Management beat expectations on most fronts. 16% year over year revenue growth, operating margins of 32%, which are very high, and very high net income growth, although a lot of that was a result of the breakup fee they received. So earnings were artificially high this past quarter. But what has investors most worried is that, as we described, their subscriber outlook remains uncertain. The reason for this is that Netflix has made a lot of its money recently from essentially forcing users to have their own accounts by cracking down on password sharing. So they've increased their sales even though the actual viewership for their content hasn't increased as much. They've also made a lot of money simply by increasing prices, and so a lot of their revenue growth hasn't necessarily come from new subscriber growth. And so the main point here is that future growth in subscribers has to come from some of the less saturated markets. And in that regard, they've done pretty well. Their LATAM growth was strong at 19% year over year. Their EMEA, Europe, Middle East, and Africa growth was also strong at 17% year over year. But if you look at some of their international markets on an FX neutral basis, the top line growth rates are also decelerating. And that's the case in both EMEA and Asia Pacific. So essentially, Netflix needs to look for new ways to make money. The growth isn't going to come as easily as it has in the past. On top of that, Reed Hastings recently left the board. He was co-founder of Netflix and he led the company as co-CEO until 2023. And he was clearly instrumental to the fantastic run they had. So him leaving obviously creates some uncertainty about the future direction of the company. And of course, that's something that the market doesn't quite like. So what is Netflix going to have to do going forward? Well, they need to show investors that they have new ways of driving growth. The Warner Brothers deal was a bit of a red flag to begin with. For many investors, it was a signal that management didn't feel that they could continue to grow the business organically through their own content, so they tried buying another business to fuel that growth. And even though they walked away with almost $3 billion from the deal, they still maintained their forward guidance, which to some signals that they're running out of ideas on how to expand. And so what they need to do is pull on several different levers, and this is management's plan. The first is their advertising business. In Q1 2026, more than 60% of their new subscribers joined the ad tier, which is Netflix's cheaper subscription that includes ads. Now, this is great for the business because they actually make more money per user off of the cheaper tier. They not only get the monthly subscription, which is around $9 per month, but they also get an additional $8 to $10 per user per month, depending on how many ads the user watches. So this subscription tier growing fast will enable them to develop into a media powerhouse rather than just being a content library. So management is focusing heavily on the ad side and expects ad revenue to double by the end of the year to $3 billion. Now that $3 billion is still a really small sliver of the overall pie. So this is really just the start. There's a lot more work that needs to be done in order to make this a really significant part of the business. Now the second lever is to niche in on international markets. Netflix needs to get new subscribers from the markets it's less saturated in. And in that regard, they have to continue being creative about the products and services they put out to attract users from those markets. Last quarter, they cited the success of the World Baseball Classic event, which they held in Japan, and they said that this was instrumental for boosting subscriber growth in the APAC region. They've had a lot of hit shows in India and in Korea, which have been super useful for expanding into those countries, and so they need to continue putting out these types of products to folks in untapped areas in order to grow the subscriber base. And of course, they need to continue being creative everywhere, including where they already have subscribers. The US is now their slowest growing geography, and they've increased prices significantly over the last few years. So in order to keep people on the platform, they need to put out new interesting content. In that regard, they're focusing on things like podcasts, regional sports events, and games. And the hope is that all of these things will keep people engaged on the platform, keep them paying for subscriptions, and avoid losing them to YouTube, Prime, and other competitors. And finally, the last lever is AI. They're banking on new technology to help them recommend shows and content better to their current subscribers. So that's also a priority for them to continue keeping people on the platform. So these are really the things that need to happen in order for the thesis to play out well for them. Revenue needs to remain stable. The advertising business needs to grow substantially. Subscriber acquisition needs to continue strong in underpenetrated markets. And new content categories and AI integration need to attract new subscribers and continue keeping them engaged. Now you'll notice that all of these things are non-fatal. They're not insurmountable issues. They're definitely challenging, but they're all attainable if management executes at a high level. Alright, so moving on to key metrics, the business looks like it's in great shape. Netflix has a fortress balance sheet, strong in terms of both short-term liquidity and long-term solvency. Their moat shows up really well in the numbers, strong ROIC, strong earnings and revenue growth in both the long term and the short term, although the forward earnings expectations are a bit more muted as we said before. Now in terms of valuation, we think that they're actually trading at a slight discount to fair value. This is based on our proprietary relative valuation approach. And for Netflix, we use 3 multiples to get there, a PE of 30 times, an EV to EBITDA of 14 times, and an ROIC adjusted EV to IC efficiency multiple of 48 times. Now, how do we come up with these? First, we take the median multiples for Netflix's industry over the last 7 years. These serve as our base anchors. We then adjust those multiples upwards using the median of Netflix's immediate peers, and we do a final adjustment to account for Netflix's own historical median over the last 7 years. We then take the fair value estimates that each of these multiples produces and blend them together in a weighted average. And in general, though it depends on the company and the industry, the vast majority of cases produce a fair value estimate that tends to be on the more conservative side. So when we use this approach, we get a 15% discount for Netflix at the current prices. And what's nice is that every single multiple produced a fair value estimate that actually had very high agreement with the others. And that tells us that there's little noise in the final estimate that we get. All right, so zooming back out, is this a compelling buy at the moment? We don't see why not. This is one of the best companies in the world. It's the leader by far in its category in terms of revenue and earnings. And the name Netflix is a part of global pop culture. Literally everybody I know, including myself, has an account. And in addition, most of us stay on despite the fact that they keep hiking up prices. And that simply means that they're doing something correctly. They're putting out a ton of content that many people like. They're also showing that they can do this in international markets well. So yes, the competition is very fierce from Amazon and Apple TV and HBO and many others, but the business is far from being broken. There's nothing fundamentally wrong with their business model. They're maturing. We should expect growth to taper off at some point, but the growth numbers are still actually pretty solid in most cases. So the road does get harder for Netflix, but for a business of their brand and their reach, as well as their quality, we can't say that this is not an interesting opportunity to think about. So, in short, Netflix is a solid business, trading at a pretty fair price, right below the minimum of its fair value range. Yes, there are some execution challenges, but none of it is impossible to achieve. And given management's track record of success in the past, we think they'll continue to do really well. So if you like this video, you found it useful, subscribe for more. We'll keep them coming your way. If you're looking for a platform to help you do all of this type of analysis, check out valuearbitrage.com. That's what we used. It's free to sign up, so definitely go check it out. All right, we'll see you at the next video.